All right, so yeah, whether it was by accident or not, but I think the sequencing of the talks is perfectly timed. I think Bazak's great talk about JP Morgan's initiatives around digital cash is a perfect segue into what I'm going to talk about today, which is some of the use cases and some of the possibilities that she alluded to when it comes to tokenization, but particularly when it comes to combining something like digital cash with other applications. So my talk is titled Unlocking Interoperable Capital Markets, Frictionless Asset Mobility on the Canton Network. That's a mouthful, so I put in an alternative title, which you'll see in a second. My name is Georg Schneider. I work at Digital Asset. I lead the financial engineering team there. We are the creators of the Canton blockchain and the Davos smart contract framework, and we're really trying to bring that into financial institutions, institutions of other industries to leverage this new technology and get value out of it. And speaking about value, so the alternative title to this presentation is Asset Tokenization, So What? And the reason why I picked this maybe slightly provocative title is really that what we've seen in the industry is that a lot of the projects around tokenization have really only taken the first step. So we've tokenized an asset, so what? We don't gain immediate value from the fact that we now represent an asset in a different form. So where does the value come from? How do we unlock that? And that's what I wanted to talk about today. So I want to take you through an example scenario of a particular use case where really tokenization is the enabler, something that you cannot do without having tokenized the asset, and really pinpoint where is the concrete, tangible business value that firms are getting out of this. And then, if all goes well, I'll show you a demo of some of the applications that we've developed end of last year as part of a pilot program that we did for the Canton network. But as you know, with live demos, you never know whether it'll actually work. So the example scenario is really centered around reducing risk and optimizing capital efficiency, and in particular using real-time collateral and margin management, which is really something that's very fundamental to the financial industry, right? Collateral is omnipresent. It's used to make the system more safe, more secure, but there's a lot of inefficiencies in the way we use collateral and margin through the business processes. So the way margin works today is really that on most marketplaces, we essentially follow a daily margin cycle. So you have a day full of market exposure. Based on that market exposure, margin is calculated, which you then post collateral for. So that means in total, we're looking at a 2-day risk horizon because you have 1 day of exposure and then potentially another day to liquidate the collateral in case things go wrong. So, the details here are not so much important other than really the time of that risk horizon is what determines the risk and therefore the capital requirements. So what if we somehow could shorten that margin cycle down to hours or even minutes, right? What that would have as an effect is essentially reduced collateral requirements because our risk horizon is much shorter, so there's less that can go wrong in that shorter time frame, meaning that trading entities would have a lower credit line consumption. They would essentially have less capital requirements or RWA charges, which literally means they free up money, and that money can be used for additional trading activity or other purposes. It's really, there is a huge amount of money being locked up just as this safety buffer in today's markets. And if we can unlock just some of them, that's a concrete benefit. That's value that the business will be able to leverage and really make use of. And ultimately, it results in more efficient markets, right? So what is the problem with that? Well, in today's infrastructure, settlement is simply too lengthy. It takes too long to move my collateral, right? So I could never follow like a 30-minute margin cycle, because when I instruct my custodian to move the collateral, it's going to be there the next day, right? So this is really where the settlement efficiency that you gain from tokenizing an asset, really that immediate settlement that you can move an asset from A to B, where that comes into play, right? So, so this is a case where only, or just basically putting the asset onto a more efficient settlement layer will unlock these types of use cases. And as I said, these have then tangible value for any business in that space. Right. So, really, how can we overcome these barriers that currently exist, and why is this so operationally costly? Really, there's a couple of ingredients that you need. First of all, you need to tokenize, your asset so that you can move it efficiently. Ideally, you also have a form of tokenized cash, so that's where JP Morgan comes into play. But you also need streamlined funding channels, so a way to in real time finance yourself and actually get the cash that you need, for example, for a particular margin call, right? So all of this kind of alludes to what Basek said earlier, that you have different applications that are the ingredients, and really where the magic happens is now as you start to connect these applications seamlessly, right? So having these applications on a blockchain infrastructure, specifically on Canton, allows you to really transact across these applications, and I'll show you an example of that in just a minute, and thereby really leveraging what the technology was built for, meaning composing workflows and business processes across different applications, but doing so in a literally atomic way, so that the operational risk and cost associated with doing business becomes much, much smaller. So, what I'm about to show you is really part of work that we've done end of last year. We've conducted a pilot program, as I mentioned, with around 40 organizations. We're like 150 people, so quite a few attendees to manage. And what we've done is we've put a handful of applications in place and really wanted to show concretely what does it mean if I transact across these applications, and how can I, for example, show that specific scenario that I've talked about just now. How does that work in practice, and how does it look like? So the particular scenario that we played through as part of the pilot is slightly more than what I'm able to show today. It involved essentially 6 different applications: a bond registry holding tokenized bonds, a cash registry holding tokenized deposits, or deposit tokens, if you will. So that could be, for example, the JP Morgan deposit account, blockchain deposit account, a fund registry, because we also wanted to show how bringing, for example, something like a money market fund into its tokenized form, you can then use it in such a context. And for example, instead of funding your margin call with cash, you use an interest-bearing instrument, which is of course preferable from an asset manager perspective. Then we had a simple trading app, which essentially just allowed you to agree on a DVP transaction. So that was used to purchase the money market fund from the fund issuer. We had a financing app, so that's really supporting a repo transaction, meaning that if you're holding a bond, but you need cash for your margin call, you can repo that bond, meaning you sell the bond, receive cash for it with the agreement to repurchase that bond back at a later time. And then ultimately, the margin app is meant to be provided by something like a prime broker, where they're able to manage the margin flow and issue margin calls on ledger, and then for these margin calls to be satisfied through, for example, tokenized cash that was obtained through the financing application, through a repo transaction. So really that was the application setup. For today, in the interest of time, I'm just going to show sort of the second part, which involves entering into an intraday repo for the purpose of financing a margin call. So in this scenario that I'm showing today, there's just 3 users. There's an investor, so the party trading and having exposure, having the need to post margin. There's the repo dealer, which is really just the counterparty for the repo, so they're holding cash and they're willing to take a bond and provide you with the cash. And then there's the prime broker, who's really just managing the exposure and the margin of that investor and triggering margin calls against them. So let's look at what that looks like in practice. So I have a couple of tabs open here, and let me try and maximize this. I have a couple of tabs open showing the different applications from the perspective of different users. That's not exactly what I wanted. Right, let's keep it that way. And so, for example, we can start by looking at the margin application from the perspective of the prime broker. So the prime broker here has a margin account, maintains a margin account for the investor. They have a current market exposure. They have already posted some collateral, so that was the first part of the transaction, essentially posting a money market fund. And the margin balance is currently 0. So this is kind of the start of the day, for example, exposure when you're still risk flat. Now, of course, markets move, so the exposure changes. So here we are simply saying the prime broker is able to update that exposure according to the market movements that have happened and the mark-to-market of the portfolio of the investor. So let's say we're moving here to an exposure of $1,250,000. So we're going to update that. And what you can see now is that the collateralization level of the investor is essentially falls below a certain barrier, meaning that they have to top up the margin because otherwise, they don't have enough risk buffer, in a sense, to continue the trading activities. So what the prime broker would do is they would issue a margin call for essentially 260,000, which is the amount required to flatten out the mark-to-market of the trading portfolio against the collateral portfolio. Now, if we look at this from the perspective of the investor, we can see now that we've been issued this margin call, but we can also see that we don't currently have any collateral available to pledge or to post to that margin call. And yeah, so what do we do? So we have initialized this scenario in a way that the investor doesn't hold cash, but they hold bonds. So what we're going to do now is we're going to enter into a repo transaction to essentially finance the margin calls, so to raise the money required to post by using bonds as essentially as a collateral or by selling bonds. So moving into the financing app, we're looking at this from the perspective of the investor. We're going to create a new request for a repo. We're going to choose a certain start date. So let's say that's 3 o'clock today. And that repo is going to be repurchased, or the far leg of the repo is in, let's say, 2 hours from now. So the requested cash amount will be 260,000, which is what we require for the margin call. We need US dollars, and we're providing this generic bond instrument as collateral. And the counterparty here, the repo dealer, will tell us how much of that bond we need to sell. So essentially what is kind of the haircut applied to that particular bond. So we'll request essentially a quote for that repo, which if we switch here over to the view of the repo dealer, they've received that request and they can now essentially accept it and provide a specific quote, meaning what is the interest that the counterparty has to pay for the duration of that repo. So let's put in 20 bips here. And what is the collateral amount? So let's say we require them to post 300,000 in notional in bonds. And we'll accept that quote. So That has gone back to the investor as a firm offer, which they can now accept. And then we have essentially an agreement on the repo trade. Just doing a quick time check. All right. So what happens next is we need to settle the near leg of that repo transaction, meaning we have to do a DVP where the bond is exchanged for cash. And this is really now the first instance where we're atomically transacting across 3 different applications. We'll be updating the bond registry, changing the ownership of the bond. At the same time, we'll be updating the cash registry for the cash to move hands. And the financing app will update the status of the trade. So let's do that. So first of all, as the operator of that financing app, they are responsible for instructing the near leg of the repo, which means creating settlement instructions, 2 of them, 1 for the bond movement, 1 for the cash movement. So let's do that. Right, so now it is for the investor as well as the repo dealer to essentially allocate the respective assets to those settlement instructions. So that's kind of the preparation of then ultimately executing that atomic DVP as part of settlement. So we do that by going into, on the one side, the bond registry. We will see, first of all, we hold 1 million in bonds currently here. And we see there is 1 settlement instruction where we need to deliver 300,000 units of that bond. So we'll allocate that asset to the instruction, so we kind of lock it up for the purpose of settlement, so that ultimately when we settle the DVP, we're guaranteed that this will actually succeed. On the cash side, from the, again, perspective of the investor, they will be receiving cash, so they have to approve the receipt of that. Again, another step in the preparation of settlement. And then the same will happen, or the reverse will happen, on the repo dealer side. So they will see an instruction to receive 300,000 bonds, which they need to approve. And then on the cash side, they have the obligation to deliver the 260,000, which the investor needs for their margin call. So if we allocate that final asset, we now have a fully prepared DVP transaction consisting out of 2 settlement instructions with the respective assets, the bonds and the cash being allocated and locked. So now 1 final step remains, which is, again, this is the responsibility of the operator of the financing app to coordinate and orchestrate settlement. So they now see here what we call a settlement batch consisting of 2 instructions, which is ready to settle here. And really when I press the button here, the magic happens. As I mentioned, we're updating 3 entirely independent applications, which are controlled and under sovereignty of the respective organizations, providing these applications into the network. We're updating these atomically. So let's do that. That might take a couple of seconds. There's sort of a lot going on behind the scenes. So the magic is not really visible when we look at this, but now the batch has disappeared, and we can actually validate that, for example, looking at the investor view in the cash registry. We can look at their holdings, and we should see they've received now 260,000 US dollars. And conversely, if we look at the bond registry from the repo dealer, they have received 300,000 in that bond. And really the key to what just happened in this transaction is that this was guaranteed to all happen, or if it were to fail, then nothing would happen at all, which means it removes entirely all the operational risk, all of the sort of settlement risk, the risk of settlement fails from the equation because we can execute that atomically. And that's really bringing to the surface this key technical capability of a distributed ledger, of a blockchain, to simultaneously update different applications atomically and in a guaranteed fashion. Right, so there's one last remaining step, which is we've raised these 260,000 with this specific purpose, which is to satisfy this margin call here. So what we can see now is that we now have available collateral to post for this particular margin call, the exact amount required, and we can do so by simply pledging it, meaning that we lock it up for the benefit of the prime broker as a counterparty so that they could have recourse in case things go wrong. Right, so that was that part of the workflow. I see we're right on time. Maybe as a quick summary of what I've shown today, really the key here is that we've seen sovereign applications that are under control of the respective operator, which, if you have read, for example, the publication of the Basel Committee for Banking Supervision, is a requirement if you want your tokenized assets to be treated the same way than your traditional assets from an RWA perspective. We have seen cross-application connectivity where privacy is maintained. So that's really the whole purpose of bringing this DeFi style of transacting into traditional markets. So you need connectivity, you need control, and in our view, Canton as the ledger is uniquely positioned to fulfill both of these requirements. So if you want to do anything with real-world assets, as they're called these days, then please come to us and talk to me.
Wonderful. Thank you so much, Georg. Really appreciate you taking the time to talk us through that today.